Maybe the biggest story in finance, certainly for millions of Canadians, is they're going to be renewing their mortgage. We had a Bank of Canada with a big warning a week ago saying, hey, look out, especially, as we go through 24, but more so in 25 and 26, people got a great mortgage rate in 2020, five-year rate 221. Well, they're getting renewed. Had me thinking about a lot of questions, and I thought, hey, I know who to go to. I'm going to go to Kyle Green of the Green Mortgage. Green Mortgages, of course, have been around for 1,000 years. Not Kyle. He doesn't look it at all. But my point being, Kyle, here's a question I've had. I look at the economic stats about what's going on in Canada, what's going on in the US. One of the big differences, though, is that their most popular mortgage is a 30-year mortgage. Like something like 90% of people have a 30-year. So yes, we've had the same kind of big jump in interest rates down there, not impacting people anywhere near the same as they are here. So I've been wondering, why don't we have longer term mortgages? And I know they post a 10-year, usually not very attractive rate, but I'm just wondering what's behind that. That, again, a lot more stability would be into our system if we could have longer mortgages.
Yeah, it's just a different system up here. So in general, down in the U.S., your term and amortization tend to be the same. It's a 30-year or 25-year term and amortization. One of the interesting things that you see then is in the U.S., it seems like the real estate market is slowing down more than in Canada, because in the U.S. you can't port that mortgage and take it with you if you buy a new property. So you kind of are stuck in the same home. Whereas in Canada, we haven't seen as much of a slowdown in the real estate market because you can take your shorter term with you
Interesting.
to the new property. So that's why I think that we've seen a bigger slowdown in the U.S. on that front. But on the flip side, we've seen a bigger slowdown in our economy because our costs are going up because of our shorter term nature mortgages. So, a good percentage of people are in variable rate mortgages, probably about 35% or so of Canadians. And of course, we've already seen that as those interest rates have risen, so then have the payments. But in addition to that, most people are taking a 5-year term or even less than that. And I think that the issue, of course, is that a lot of those mortgages are coming up for renewal. We're already seeing a lot of renewals coming out this year, but really 2025 and 2026 is where you're going to see a lot of those renewals. 2021 was the busiest year that most brokers have seen in probably their entire career, and most of those terms are 5-year terms.
I like your point, though, and I should have started with it, is that, of course, it depends on the mortgage. As you say, people got variable rate. They got variable rate, but fixed, so the amount they pay monthly stays the same, basically, but less goes to interest or more goes to principal, whatever it is. So that's an important distinction because, again, in that Bank of Canada report, I mean, it was an eye popper. It should have been my shocking stat because some people, have watched like a 60% jump in their monthly payments coming out of one of the variable rates. And wow, and that's not affordable. I expect to see the fallout from that. As you say, look at 25, look at 26. We're not done yet.
Yeah. And that one of the reasons that that it's different is just if you look at how banks fund mortgages, what they're doing is they're lending out money to people like you and me, bundling up those mortgages and then selling them out the back door. The reality is that when international investors are buying these bundles of mortgages, they're also making a decision to invest in that country too. So it's a lot easier for the U.S. being the global currency to attract 30-year money because people can foresee and say, you know what, in 30 years' time, I think that the U.S. is still going to be around and in a solid state. In Canada, it's a little bit harder to raise capital on such long terms, and so we get up to about 10 years, and that's the maximum that you're typically looking at. When you go above that number, it's just the banks don't really have a funding source. It's hard to attract money into Canada for more than 10 years.
It's a great point in that I talked to Yves Giroux, parliamentary budget officer, a few times, but I remember specifically going back to November 2020 and asking him, I mean, my goodness, the government's issuing so much paper, right? Because we were having massive deficit spending. But I said, why aren't they going longer term? I mean, hey, these are great rates. I was recommending to everyone who listened to me, lock in, go long. It's more, for me, it was over financial instability worries, which I still have in some degree. But I said, so why aren't we selling them? And his answer, I'll never forget. He says, because there's no buyers.
Yeah.
Like there was nobody on the other end of that. They didn't want our 20-year paper. So your point's very well taken that you can't match the loan with the security at this point. And, as you say, that's a big difference between us and the States. It is the currency that people still around the world go to. And so they can raise that 20 and 30-year money. But even on the 10-year, I've heard from different bankers that it's just more expensive for them. One of the issues I heard was that, let's say they take out 10-year security, lend out the 10-year money, but then I break that mortgage.
Yeah.
Now they're stuck with that security on the books that they don't necessarily wanted. It was matched up. So they said that was getting more expensive for them. So things like that also play a part, it seems to me.
Yeah, it does. And there's an interesting clause in the Bank Act, actually, in Canada, where if you fund a mortgage, if you've been in that mortgage for longer than 5 years, the maximum penalty is 3 months of interest. And so they cannot charge the interest rate differential penalty. So if a couple of years ago, people took a bunch of 10-year money and they're at, 2.5% or 3%, there gets to be points where you can actually break those mortgages. And nobody would break it if you took it just a couple of years ago, because of course you're at a lower rate than where rates are at. But if the flip side happens, so if people take 10-year money today and then rates drops considerably, people could break that mortgage and just pay a 3-month interest penalty at the 5-year mark and get out of it and then redo it and get a new 5-year term. So it's very risky for the bank on the downturn because of the Bank Act in Canada.
No, that's such a wonderful point. And of course, if they're going to pass on that risk, that extra expense, that's partially at least explains why the 10-year rate never looked that attractive. My 5-year just looks way too much, way better, but that's a great explanation of why that is. I guess then we heard this year that there are banks extending amortization periods and things like that. How prominent did you find it in your business? Green Mortgages is a very big broker. You do a lot of business. Did you find that all of a sudden a surge?
Yeah. So one of the things that happens is that's more, so we would see it, but we don't deal with it and negotiate that a whole lot. So usually what would end up happening is if somebody is in financial distress, then we would usually encourage them to, if there's no other options, of course, encourage them to go back to the bank and ask for some way to assist them. And usually that would be extending that amortization. And in fact, some cases, they would extend the amortization past the 30-year mark.
Wow.
We saw some people and some banks that were extending it to 40-year amortizations almost automatically if you were asking for it. So at the end of the day, the bank doesn't want to have defaults, and they want to accommodate this and try to find options and solutions for people to ensure that they can stay in their home and they can still pay them. And that's something that we saw a fair bit. Another thing we see too is with the renewals coming up, if you bought a property 5 years ago, let's say, and you bought it with 25-year amortization, you're down to 20 years, a lot of people are finding that they can keep the payment the same as what they were at before by re-extending it to 30 years. And I know that sounds crazy to add 10 years onto the life of your mortgage, but it keeps the payments the same. And so a shockingly large number of people have opted to re-amortize it, even though getting a 30-year amortization usually costs a bit more in the mortgage, but keeping the payment the same was their primary objective.
Yeah. As I say, it's quite an environment for people to be working in. Unprecedented jump in rates. First, the decline in rates was unprecedented. Now the jump in rates is unprecedented. So people are scrambling. And I know this is such a broad question. It just sort of, I don't expect a specific answer, but someone walks in the door right now and wants to initiate a mortgage. Are you telling them 5, or do you say, here's what a 10 would cost, here's what a 7 would cost, here's the best I can get you at a 5, that kind of thing? What's that conversation look like?
Yeah, it really depends on the borrower, of course, but I would say that if I was to rank the terms in order of the number of people that are taking them, the 3-year fixed is the most commonly chosen term by a large margin. And then the 5-year fixed and the variable are about the same, and then probably a 2-year fixed, et cetera. So the current situation is that short-term rates are more expensive than long-term rates until you get up to 5 years. So a 1 year might be close to 6.5%, 7%. 2 year might be 6.25. 3-year drops to 5.25 to 5.5, somewhere in there. And then the 4 and the 5 year are only about 0.1% or 0.2% lower in most cases, other than insured mortgages. So you get diminishing returns to go longer than 3. So the 3 year seems to be that good mix of not too short of a term where you're paying a high rate, not too long of a term where you're stuck in a rate that's fairly high, and especially with the expectations that rates will drop. Technically, based on the Bank of Canada predictions in the swap markets, where people are making predictions of where the Bank of Canada is going to go, if you get a deep discounted variable about prime -1 or so, a variable is showing that it will outperform a fixed, but those same people that are making the predictions also predicted years ago that rates
Yes.
would not have increased this much. And so people are very hesitant to place that bet right now.
I'm always so conservative on that. I think, hey, I've got lots of ways to play different things, including interest rates. I can show people a lot of vehicles to play what they think interest rates are happening. My home hasn't been one of them, but, on that. But I'm sure you're inundated, and I appreciate you finding time for us today to share with us your expertise.
Of course. Thanks for having me.
Great, Kyle. Kyle Green, Green Mortgage.